Good afternoon, everyone. Welcome to AMMB's first half FY2012 financial results and performance update. We're going to do both a live presentation and also a telco and also a video presentation so that other analysts like yourselves, shareholders and other fund managers can also witness the update presentation. We will start with Mr. Chia starting off the main presentations, followed by Ashok. And then we will do question and answer, which we will then take a live question first, and then we'll go to the telco to take the second question from the telco, and we'll alternate. So let us now spend just a few minutes just for the telco operator to put down the ground rules. Grace?
Thank you. Ladies and gentlemen, thank you for standing by and welcome to the AMMB Holdings Berhad briefing for H1FY2012 financial results ending 30th September 2011. At this time, all participants are in the listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask questions, you will need to press star 1 on your phone. I must advise you that this conference is being recorded today, 6th September 2011. I would now like to hand the conference over to your host today, Mr. Ganesh Kumar Nadarajan. Thank you. Please head back.
Thank you, Grace. So, Mr. Chia.
Okay. Good afternoon, everyone. Welcome to today's presentation of our half-year results, which we got approval yesterday. For the half-year results, we have actually 18 profitable quarters, and we are happy to report for the profit after tax for the first half is up 16% with improving ROE naturally. And the profit growth is actually underpinned by higher non-interest income and lower provision. We experienced very stable NIM, good CASA and targeted loans growth. The capital base that we have today is well positioned to meet Basel III, and we are proposing to pay interim dividend of 6.6%, which is up 10% of first half last financial year. The results come about largely from very disciplined strategy of executing of our execution. And if you look at the results, for which Ashok will give you greater detail, profit before tax is actually, before provisioning, is up 8.3%. PATMI is up 15.7%. ROE is 1% higher compared to the previous half. ROA is 0.05% higher, and earning per share is up 16.3%. The higher income is actually coming from the strong performance from our non-interest income, and despite the fact that we have higher Q-on-Q provisions, but we have improved on year-to-year basis. The sectors that really, our line of business that really grow, largely comes from the corporate institutional group, the investment banking, the markets, and the general insurance. We do experience a decline of about 5% in the retail side, and the business side about 25%. Both of which actually, in the retail side, largely impacted by margin pressure, and the business banking side is actually impacted by some provident provisioning. On the net lending side, we have a first half recorded 72.6 billion, up 7.2%, and that is notwithstanding the loan sell down and refinancing via DCM itself. The customers' deposits is 81.3%, up 10%, and CASA is 10.6 billion, up 20.5%. As I was saying, the improved results that we have actually here have better capital adequacy ratio. Our tier 1 is common equity tier 1 is 8.3%, and our tier 1 CAR is 10.4%. And of course, the more important, the gross impaired loans ratio is 22.75%. All are improved results. And the cost to income is 39.4, up up slightly, largely due to our implementation of some core projects. What we think we are ahead of us, of course, right in top of mind, of course, is where the Malaysian economy will be going forward. We think that the Malaysian economy will be in the region of about 4.5%. Of course, the official forecast is between 5 to 6, largely because there's a great concern of the contagion effects from the European crisis and the American economy as well. But fundamentally, we think that Malaysia will be well poised to benefit from the internal economic measures. We have the ETP that's coming on, and also that we also see some incentives coming out for the budget 2012, which will benefit the economy as well as the industry. What we will do is that we still focus to our strategy. We still focus on growing non-interest income, building up our CASA, as well as focusing on profitable sectors and viable segments of the economy. We expect to have more subdued market sentiments, but the ETP and the budget itself will provide future opportunities. With the partners that we have in the bank as well in insurance, we will leverage on them and to build what we call the international connectivity for growth. Generally, we are of course very cautious on the short term, but we will stay much aligned to our medium-term aspirations. Of course, we keep watch what will happen further to the economy. Thank you. I will ask Ashok to give you the details of our results.
Thank you, Mr. Chair. I'm on slide 9 of the deck, which is taking a look at the financials in further detail. As Mr. Chair said, the profit growth was underpinned by higher non-interest income and lower provisions compared to the same period last year. And if you take a look at the composition of that, you can clearly see that the non-interest income is now at 37% of the total income contribution to the group, and our interest income has been relatively flat, up from what was a reduction in the first quarter of this financial year. We have continued to invest through the first half, and we intend to continue to do that out into the future. And as we had foreshadowed before, there is a small increase in the cost-income ratio of 0.7% compared to the same period last year, but that comes in from continuing to invest for the medium-term aspirations and returns that we would expect from this bank, from this group. The divisional contributions are on slide 10. If you take a look at I'll talk about the highlights first. Clearly, the standout is markets. Markets has come in with very, very strong revenue growth, particularly from fixed income activities, but also from good contributions coming in from FX and derivatives. You've had general insurance put in a very, very good performance compared to the same period last year, up 59%, and it's come through a combination of both growth on the premium side as well as better claims management. In terms of investment banking and CIB, they've both leveraged the economic activities for better returns for those divisions. And as you heard Mr. Chair talk about the three divisions which have got arrows pointing the other direction downwards, we've had relatively stable revenues in retail banking, and despite the overall NIM reductions, we managed that through some volume growth and some other incomes, as well as lower provisions. The principal reason for the reduction in the profit contribution has come in from rising costs as we've stayed investing for the medium-term returns. In business banking, it's principally the function of one large provision which came about as a result of a restructuring exercise that we did in the previous global financial crisis, and in the current economic environment, we felt it was prudent to take a closer look at it and take some additional provisioning, which we have done in the current quarter. And in terms of the life insurance, the profit transfers have been lower. We are in the process of realigning the business priorities more towards the banker channel as well as the better performing agencies. In the meanwhile, we're held back transferring some profits to the shareholder funds until such time as we can understand exactly why we'd like to end up on those strategies. Within the non-interest income space, which is on slide 11, you can clearly see that the largest growth has come in from trading and investment activities, and as I said, a large part of that has come in from fixed income, from our fixed income portfolio, both held for trading and available for sale. As we've lightened into a falling yield curve market, the ability to continue to generate those returns out into the future period will be lower, and hence when we talk about guidance from this business, it's likely to be lower for the second half, but the first half has been a particularly pleasing result from the markets division. And the other pleasing thing to note is that we managed to, as Mr. Chia said at the outset, stabilize our net interest margins. We had a bit of a reduction, a steeper than expected reduction in the first quarter, and we said we will try and preserve our margins going into the second quarter, which we have done, indeed slightly increased it in the current quarter compared to the previous quarter. And we've traded off asset growth for NIM preservation, and that's clearly come out in the fact that our loans growth is at just under 8%, including the sell downs, but our margins have clearly improved quarter on quarter. And the challenge for us is to try and ensure that we continue to manage that mix between net interest margins and loans growth going into what's likely to be a more subdued and a more volatile market. Moving on to slide 13. Our asset quality continues to improve, notwithstanding the fact that we've said, we've been prudent about the way we've impaired some assets in the current quarter in business banking. Our overall impaired loans ratio continued to trend downwards. It's at 2.75% at the end of the second quarter, the first half of the current financial year. Our provisioning cost is within the range that we indicated that we'll achieve during the course of this current financial year of around 50 to 55 basis points. At the end of the half, notwithstanding again the prudent provisioning we've taken for one of the loans in business banking, our provisioning cost is somewhere in the middle of our total cost loan loss provisioning charge to P&L at 53 basis points. And our loan loss coverage continues to be healthy at above 100%. So notwithstanding what you've heard me talk about in terms of the impairment of one of the accounts and prudent provisioning, generally it's within expectations that we had guided the market to expect from us. Now, the page after that, again, is a continuation of the story that I've just mentioned, which is the fact that we've impaired one of those loans has meant that the new impaired loans ratio has increased in the current quarter. That's been offset by recoveries, where we've continued to harvest our previous impaired loans to get some returns back into our portfolio, and where we can, we have taken a look at what we can write off prudently on amounts that we provided for previously, and we've done that this quarter as well. But nevertheless, the one blip on that page, which I expect more questions on, is around the new impaired loans, which has gone up compared to the same period last year, as well as compared to the previous quarter. Our portfolio rebalancing continues to make steady progress. You heard us talk about having a proportion of retail, non-retail loans in our portfolio closer to the 50-50 mark over a 3 to 5 year period, and we've continued to make inroads towards that. Adjusting for the sell down, we are at 62-38 between retail and non-retail, and that, as I said, it's a steady progress that we would continue to make over the next few years to come in that space. And as you can see from in terms of the pure lending growth, as well as the composition, both business banking and corporate institutional banking have been the faster growing areas for us. The other aspect on that page to highlight is the fact that the proportion of variable rate loans continue to increase. Our variable rate loans at the end of September is at 53% compared with 38% a few years ago, and we've made significant inroads into aligning our business strategy to grow more variable rate loans in our portfolio through not just the business banking and CIB areas, but also even in retail, in particular focusing on our auto financing, a high purchase, where we were the first ones to introduce variable rate loans as a product feature in what we do today. Moving on to the slide after that. Look, one of the things we are particularly pleased about is the stability of funding in our portfolio. We have talked about that as one of our key priorities, and today 96% of our funded assets are financed by equity, customer deposits, and longer-term debt. And in terms of that debt, we've got well-distributed maturity profiles or a number of years out into the future. And hence, we have brought in more stability into our funding. We know that that's cost us a bit on the cost of funding side, but it was a deliberate strategy on the part of management to give us more stability in a potentially volatile environment. We've also had an additional issuance of around 600 million in sukuks during the course of the current quarter, but that's been the only addition to our overall debt and debt capital issuance in the current half. Moving on to the slide after that, our AUM continues to improve at a healthy clip in the funds management entity. Our brokerage market share has come off a tad. It's come off on the basis that we did not want to participate in some discount broking activities that appear to have happened in the last 6 months. We will watch that, like with every other part of our portfolio, to ensure we get the right returns from that business, even if it means giving up a marginal market share for a short period in time. In terms of our general insurance portfolio, that's continued to grow. And as I said at the outset, the better performance in general insurance has come in both from rising premiums and incomes, as well as managing our claims better. In the life insurance space, whilst our funded assets have grown, you can see that the gross written premium has come off compared to the same period last year, and that's a function of the fact that there are certain products that we believe are capital intensive in the current marketplace that we would prefer not to sell, as well as we are realigning our business model in life insurance with a particular focus on ensuring that the better performing agency force gets better support from us, and with a greater emphasis on bank assurance channel for us. All that has meant that we've continued to deliver higher shareholder returns. Our return on equity at 15.4% is up compared to the same period last year and for the full year last year. Return on asset, again, is more healthy today, and our EPS and our dividends continue to increase in line with our better performance. Moving on to slide 18. As Mr. Chair said at the outset, our capital is well positioned, we believe, for Basel III. We've, in our risk appetite framework targets, have said we'd like to maintain our common equity ratio at 8% plus or minus 1, with a tier 1 of 10% plus or minus 1.5, and a risk-weighted CAR of 14% plus or minus 2. And those numbers are in our ICAP document that we have given to Bank Negara. We are waiting for feedback from Bank Negara on what their expectations would be, and should we need to refine it after we get feedback, we will do so. But at this point in time, based on our risk characteristics and profile, we believe these are appropriate numbers for us to carry. In terms of the outlook, look, whilst we've delivered a first half result that's at the upper end of our expectations, we've guided the market to expect lower returns for the remainder of the year, and we've said expect a profit growth of around 10 to 12%. This comes about as a result of 3 key reasons. The first one is we believe we need to be more conservative in our lending in an environment where we can see more of the global impacts finding its way to the Malaysian shores. And we need to trade off that with preserving our net interest margin and ensuring we've got the right quality portfolio in our loans. The second key area is fixed income, which I alluded to, where markets have clearly lightened the portfolio and shortened the duration in a period when rates were falling, which was exactly the right strategy. We need to think about how to build up that portfolio over time. We will get opportunities to do so, but that will mean the traded element of that portfolio will be lower in the second half compared with the first half. And the third element is the fact that we continue to provide prudently through economic cycles. As we've said before, we are the only entity, we believe, in Malaysia, at least from what we've heard, to have economic cycle provisioning. We've been proactive in terms of provisioning, in terms of providing for entities that we believe will be harder for us to restructure in the current environment compared with perhaps a year ago. And we've done that very consciously and very proactively, which would mean that our ability to continue to generate those outperformance returns that we've done in the recent past is likely to diminish as part of a deliberate strategy in how we'd like to position ourselves into the next 6 to 12 months. Now, within that, our fundamental priorities haven't changed in terms of profitable growth, rebalancing, our diversification, in terms of how we look at new business development, growing non-interest income and deposits, and within deposits, CASA in particular, as well as ensuring that we stay focused on our customers, and ensure that we cross-sell into that customer base, increasingly so, to generate the outperformance returns over the medium term. Now, we've given some guidance for each one of the divisions, but that broadly is captured in the way I've presented the information so far. And hence, given we are halfway into the financial year 2012, we've given some guidance for the remainder of the year as well as for the full year, where we've said expect PATMI growth to come in at a slower pace for the remainder of the half and for the full year. We've said it's likely to be lower of somewhere in the region of 10 to 12%, compared with our previous potential expectation of around 14 to 16. Our return on equity, again, as a result of the headline PATMI growth coming off a tad, means that we'll continue to generate returns that are similar to or slightly better than last year as we build up our capital again in anticipation of Basel III. In terms of a cost-income ratio, we will continue to stay invested for the medium term, which means that expect to see a bit of an increase compared with the historical numbers of just below 40% in terms of cost-income ratio. We believe that in the current environment, our ability to improve impaired loan ratios will get harder. And so we've said, expect that to remain at current levels, possibly lower, but we're not sure, and that's one that we need to continue to manage well. And we're at this point in time maintaining our dividend payout ratio expectations, subject to Bank Negara's feedback on our ICAP document, which we have given to them, and we are in discussions with them as we speak. So in summary, a first half result that's in line with our expectations, perhaps at the higher end of it, but expecting a slower second half. Our strategic themes around staying focused on generating good non-interest income, faster growth, targeted loans growth will remain. That's indeed in line with our medium-term aspirations and strategies. The market conditions will be more subdued, but we expect ETP and Budget 2012 to give us some future opportunities, which we need to be ready to capture and harvest. We will continue to stay invested in the medium-term infrastructure that we've started building a few years ago and will continue to build out into the future whilst maintaining high standards of governance. And that's not just in the governance space, it's also in the business end. And as you've heard us talk about it in the past, we are one of the significant investments we are making is replacing our core banking platform. Our strategic partners are all important, whether it's ANZ in banking, IAG in general insurance, or Friends Life and life insurance, and that international connectivity will continue to be leveraged for growth, which in our view is a significant differentiator for us. And the outlook in the short term is one where we need to be a lot more cautious. Clearly, we would expect a bit more turbulence, a bit more volatility, a dampening effect from the global events. We're not talking negative growth in terms of GDP. We're simply saying slightly slower growth compared to what we might have seen in the recent past. And hence we are staying aligned to our medium-term aspirations, spending further clarity on which way the global economy and indeed the Malaysian economy is headed. Should that result in an even slower growth than what we anticipate today, we need to be ready to react, and that's indeed our current stance. On that note, I thought we'll just conclude and throw the open for any questions to Mr. Chiao-Ming.
Can we have a question from the floor, please? Okay, then why don't we take a question from the telco? Grace, do we have any question from the callers?
Sure. We have a question coming from the line of Leong Kee Wei of CLSA. Please ask your question.
Hi, thanks all. Okay, I have three questions. I just want to understand, because I was looking at your total assets, quarter-on-quarter it actually declined. Is it a conscious effort to create your balance sheet? That's my first question. Second question is, if I look at... yes, hi.
Hi. Can you repeat the first question, please? And can you speak a bit louder a bit? We're having difficulty listening to you.
Oh, okay, sure. All right. I was looking at the total asset. It declined quarter-on-quarter. And I just want to find out whether it's a conscious effort by the management to deleverage your balance sheet. And my second question is, since you mentioned about targeted loans growth, your loans growth actually, I think, contracted quarter-on-quarter. So in which segments are you focusing on growing loans, and which segments are you actually looking to reduce loans? And thirdly, in terms of the impaired loan on that business loan, is it one big corporate loan that was restructured previously, and has it actually gone bad again, or can you give us some color on that?
Look, I mean, in terms of balance sheet growth, we've always talked about growing the better quality loans at a faster pace, in particular focusing around CIB and business banking. And that's fundamental strategy hasn't changed. There are certain subsectors within that that we believe we should be even more defensive and conservative in leading into an environment that's probably, as I said, going to be a bit more volatile. On the retail side, clearly our strategy again is to ensure that we focus on viable segments, and you've heard us talk about the mortgage segment is one where it's hotly competed based on price, and the economics of that are ones that give you little, if any, return on equity, and we continue to participate selectively in that space, but we need to be even more selective, in my view, to ensure that we get the right returns over the medium term for the shareholders, and that imperative hasn't gone away. As a strategic imperative, we'd like to grow mortgages, but not on current price. And again, we've taken a look at what niches we can do in that space, and some of those niches are disappearing as we speak. We've also had some sell downs, and that's coming through a conscious effort where we've looked at loans sell down or repaid for capital market activities. And if you'd seen the growth that both CIB and IB have seen in the revenue side, which has helped underpin a very solid result in both the spaces, that's coming as a result of some activities on the lending side that we did some time ago, which has since been replaced by a capital markets activity. That's again a deliberate strategy. So generally speaking, a broad thrust hasn't changed in terms of the shape of the balance sheet that we would like to see over time. A little bit of refining as we speak in a market that's potentially going to be more subdued and slightly riskier. Now, your other question related to impaired loans, and across the portfolio, we haven't seen any major signs of deterioration. If indeed, it still appears to be solid. There are two pockets of areas where we continue to very closely watch over, and both of those are ones that we foreshadowed in the past. One relates to this large corporate loan that, as I said, we impaired a part of it some time ago. As part of the last financial crisis, we were in the throes of restructuring it. And in the current financial crisis that happened a little while ago, it appeared those restructuring efforts were going to get harder. And hence we've taken a close look at it and said, we need to impair not just one facility, we need to potentially impair the total group and take some provisions for it, which we have done. The other one relates to the co-op facility, which you've heard us talk about again probably about 12 months ago, when there were some regulatory changes, which meant that our capability to write those loans use sinking fund as a way of buffering our provisioning disappeared because of some external regulatory changes. And that's a portfolio we continue to watch closely over, and where we need to be conservative on it, we have taken provisions against it. But outside of those two, I think our impaired loans are still looking pretty healthy. Our ratios in MIA and so on and so forth are still looking very solid, if indeed improving. So as of today, we haven't seen any signs of deterioration. We're just being proactive and careful about how we might see the next 6 to 12 months evolving in that space.
Thank you, Jiwei. Can we have a question from the floor?
Your net NPL ratio, you're expecting it to be lower. But
Yeah, look, I think the house view on rates seems to be changing by the day. Not surprising, given the external market seems to be changing by the minute. So we might have expected a rate cut if you'd asked me the question a few weeks ago. And now the house view appears to be leaning towards one that says potentially rates are going to stay at these levels. There's still the next meeting that's going to happen end of January where we might get a bit more color to it. But on balance of probability, it looks more stable for the rest of the year as opposed to falling. Okay. Again, we will. Would be my expectation around the net interest margin. So we've said, look, we'd like to preserve our NIM and ensure we get the right lending growth in the right sectors, and that's a conscious trade-off that we'll continue to do. There might be opportunities for us to potentially lengthen margins in a period when we know there's going to be increasing volatility. But the best way to think about it is we haven't seen in the credit portfolio any emergence of credit spreads widening. In our PDS portfolio, we've clearly seen that, but not in our credit portfolios yet. We'd love to see that, by the way, but at the moment, it's not happening and competition is still intense. The second question was around balance sheet, and what's the structure of your balance sheet and what would happen if there's a rate reduction or a rate increase. Generally speaking, what we said was, some time ago, that we'll try and have a flatter balance sheet in terms of balance sheet mismatches through different durations. We're still slightly leaned it towards rate increases. We're looking at how we manage that on a more dynamic basis. But a balance sheet generally is positioned such a way that if the rate cuts or rate increases, it doesn't have a significant impact on our overall revenue growth. And yeah, the way to think about balance sheets are using both assets, liabilities, and off balance sheets, which is the reason when I talk about the structure of the balance sheet, if we do more variable rate loans, we need less hedging activities. If we do more fixed rate activities, we'll do more hedging. So either way, the net impact of that is what I've captured in saying the balance sheet mismatches through different durations are relatively neutral. We've still positively leaned it towards rising interest rates, which we think is the more likely scenario or the medium term, except we don't know what the next 6 to 12 months is going to bring for us, okay? So that's the structure of the balance sheet, and that also guides what happens to our net interest margins. I forgot your third question. Yeah. Look, the way to think about it is when we talk about broad expectations of 50 to 55, it takes into account two things. What accounts we might need to provide for, and what accounts will we recover on. Okay. So that's the reason why I said if you said 50 to 55 is broadly what we had guided the market to expect, at 53 it's somewhere in the ballpark. So I'm not going to strip it out and tell you what the one-off is, because we might have had some one-off recoveries to help offset it as well. Okay. So expect that as in a portfolio sense, around 50 to 55 is what we said we would achieve. We're in the middle of the range at the moment. Yep. And yeah. There is, but it's the offsetting impact to that is the one where I said, and Andrew or CRO can comment on it. But really speaking, when we take a look at MIAs, it appears to be still in a trend which is stable, and watch list as well. Correct. MIAs, it appears to be stable. So there's nothing systemic in our portfolio that we're particularly concerned about. But again, we do know that the next 6 to 12 months are going to be very, very cloudy in an economic sense. Okay, and hence we've said. And not the word pending further evidence of economic directions, because we're not sure whether it's upside, downside, and every commentator has got a different view, and that changes by the minute. So we don't know. It's a short answer. Yeah, over time. Sorry. Correct. Malaysia. Yeah, I mean, do you want to just?
Can one of you just pass the mic to them?
Yeah, Mike to Andrew.
Take out the mic.
Sorry, we have a lagged impact from Europe and America of traditionally 6 to 9 months, we've started to see softening, although overall the economy is doing quite well. It's really what happens in the next 6 months, next 2 quarters, the one we're currently in and into March, and obviously through to June, if we see any more sizable slowing of our economy. At the moment, clearly business confidence and consumer confidence is a little rattled, but our economy is doing well. So it's really just watching the signals. But overall, a dampening may be, but still positive economic growth is what we're expecting.
Okay, we will now take a question from the telco. Grace?
Your next question comes from the line of AmBank Lu of HSBC. Please ask your question.
Hi, everyone. Just wanted to follow up on the question with regards to the balance sheet shrinking. I did notice that your deposits also fell, and most of it actually was from fixed deposits. Can I just check if that is conscious, and what was the reason behind that?
Gavin, look, we operate a loan deposit ratio of 90% plus or minus 2%. Adjusted customer loan deposit ratio of 90% plus or minus 2%. So as our lending growth varies, we would take a look at how we grow our deposits, and they go in tandem.
So it's conscious?
It's conscious, yeah.
Okay, thank you.
Thanks, Gavin. Can we have a next question from the floor, please? Would you mind to use the mic so that the telco people can answer?
Okay, Wee Xiang here from BNP. What's your core equity tier 1 based on the Basel III definition, the strict Basel III definition? I think currently, based on the slides, it's 8.3%, right?
Correct.
But is that number based on the strict Basel III definition?
The short answer is yes.
Okay.
But remember, it's for the aggregated banking entities, and Basel III haven't still told us what it is for the holding companies yet.
Right. I think I should know your answer for this, but I just wanted to be safe. Do you have any Eurozone exposure?
Eurozone exposure. Look, we're a largely domestic bank, is a short answer. Sorry? Yeah, look, there might be some stuff in FI more from a settlement perspective, but we don't. We're not in the business of doing. Yeah.
Eurozone bonds or securities or sovereign bonds?
No.
Okay. Sure. I think there were a lot of questions based on the business loans that you guys were exposed to. Which industry do these business loans come from, or business impaired loans come from?
The particular impairment that we're talking about?
Yes, that's correct.
Look, it happens to be in our preferred sector.
Sorry, say that again?
It happens to be in one of our preferred sectors, okay. And it was a loan that was done, as I said, 4 or 5 years ago. It's still with us.
Right. The second question is this industry-wide loan exposure or just only specifically for AMMB? Based on your best knowledge.
I think based on our best knowledge, it's largely AmBank's exposure, as far as we know, right?
Okay, Grace, can we take the next question from the telco?
The next question comes from the line of Harsh Modi of JP Morgan. Please ask your question.
Hi, gentlemen. Thanks for the call. Had few questions. First is on the duration. You're saying that the tilt is slightly towards the rate rise. Now, is there a reassessment of that position? And if yes, will there be an impact on the as in what sort of impact it would have on balance sheet of P&L over the next 12 months?
That's a very straightforward answer, Harsh. We've got Galco that meets once a month. We look at it probably at least once a month, if not more often, to see whether we need to change our stance on that. If we can put on in the short term some fixed rate assets at the right price, to in the right durations, we'll take a look at it. I mean, that's just, or if there are things that we can close out in the right duration on the liability side, we'll take a look at it. But it's at the margin. You're not talking big numbers either side of it, okay? So we do set value at risk, we set earnings at risk. We're at the lowest end of both those numbers as we speak, okay? So well within whatever risk appetite settings that we had set for ourselves.
Right. So no major investment shift in AFS portfolio or any major losses or gains on shift on the portfolio on either side of the balance sheet.
That would be correct. Yep.
Okay. Other thing on the asset quality, I understand this impairment was largely one-off, but broadly across both business banking and consumer, especially on the auto portfolio, which has been your traditional strength, though you have been shifting away from it last few years. Do you see that as a risk? And broadly on credit card and auto portfolio, how do you see that panning out over the next 12 months?
Well, again, I mean, all the lead indicators are suggesting it's stable. And, we are continuing to see some improvements in those portfolios, particularly in auto financing, as the mix of the old and the new continues to shift towards the new, which is of better quality. So, and again, it's one we need to continue to manage, watch over very carefully, because we're going into an environment again that, whilst not being a repeat of what happened in 07, 08 or whatever, is going to be shaky. So we know that, and hence the reason why we're being a little more cautious in our forward outlook compared with what you might have heard us talk about in the past, in the recent past anyway.
Right. And what would you reckon would be a through the cycle provision number? Because you look at it from that perspective, from through the cycle perspective.
Yeah, look, previously we'd said expect around the 50 basis point mark, given our portfolio shape and size and quality. At points in time it might get slightly better than that. At points in time it might get slightly worse, because unfortunately under the FRS model, as you know, it's the incurred model as opposed to the dynamic provisioning or smoother economic cycle provisioning model. But who knows? In the next 12 months we might see some new provisioning methodologies coming in, or accounting methodology being introduced in that space. So it's 50 basis points, give or take. Either side of that, a few basis points would be our broad guidance.
Right. But if we are I kind of got a sense that you are preparing for a more cautious outlook. Under that scenario, do you think 100% coverage ratio is enough going into a downturn, or a slowdown rather, or do you expect higher coverage over the next few quarters?
Look, whilst I proudly talked about 100% coverage, I think I've also mentioned in the past that the coverage ratio is a meaningless number, because unfortunately the numerator and the denominator are not entirely aligned. The numerator talks about your provisions, your denominator talks about your impaired loans. And we know under the collective provisioning methodology, a reasonable part of that, your provisions, is not on impaired loans, it's on performing loans. And hence, what the coverage ratio is, gives you a sense of comfort, because everyone uses the ratio, but it's just the numerator and denominator is not aligned, and hence it's a ratio, it's one of your portfolio of ratios to use, but not one that outplays dominance in terms of thinking about asset quality. Having said that, I mean, we're generally comfortable. As I said, look, we think 50 to 55, probably 50. We manage it through economic cycles, through the economic cycle provisioning and the model risk provisions we've got. We're strengthening our provisioning models as we speak to get a better feel for a 5 or 7 year view on it, which we'll have in place before the end of the financial year. And all that gives us greater insights into the quality of the portfolio we've got. But based on what we know today, I think that broad guidance we've given you appears okay. It might be slightly higher in the next 6 to 12 months. But again, I'm not talking about big numbers on either side of it, based on what we see today.
But are you seeing any changes in the PD, LGD numbers? Is there any significant shift on either side in your models for next couple of years?
Look, generally speaking, we've had an improving trend. Okay. Even as we speak, it's our lead indicators are suggesting stable, possibly slightly better. So that would suggest automatically our PD LGDs are better than what we had 2 years ago.
Okay. If I may, just a couple of more questions. One is on ETP. What kind of, are you seeing bond mandates and capital raising mandates coming to you right now, or how should we think, when exactly does it start showing up on the balance sheet P&L?
Well, I mean, as far as the ETP is concerned, of course, some projects get implemented faster than the others. And I would say that we have a reasonable share of the mandates that of projects that are being implemented.
And any guidance in terms of timing when we could see probably on the DCM side of it showing up on your P&L next quarter, quarter after next?
Well, if we look at the timing of the projects, the amount that we will be mandated will be a fair share of the market. In terms of actual numbers, we will see the share of the market will depend on the others that are coming up, and you will see that there is actually quite a number of GLCs doing their refinancing at the same time. So let's see how the markets, the timing of these are being introduced to the market.
Thanks. So just a final question. That's on funding cost. Do you see significant competition still for the core deposits? I understand you let go of FDs this quarter, but on the core deposit, how bad is the funding cost? And assuming not a massive change in your loan strategy, how should we expect margins planning out over the next 6 to 12 months?
Look, I think the competition for deposits is still intense. It's a reality that banks appear to be happy to pay 20, 30 basis points above the interbank rates for similar terms. It's a behavior that we've said in the past we can't quite understand in a market that's still relatively liquid. But we're not seeing any signs of that abating, so it is still quite intense. And that's all been factored into our thinking when we talk about keeping our margins relatively stable, preserving it as a term that I used. So there's nothing that's changed in that space compared with what we saw in the previous quarter or the quarter prior to that.
Got it. Thanks a lot.
Thanks, Ash. Okay, we'll take the next question from the floor. Can you use the mic, please, so that okay. Thank you.
Okay. Hi, King for Alliance again. Just want to find out the recent quarterly results. I see that Public Bank and AmBank, in terms of their market share on the mortgage and hire purchase, they have been flattish quarter on quarter. And I saw the presentation slides that you are not disclosing the market shares for your hire purchase and mortgage. But I do see that if you look at your note number 11B, your loan is quite flattish for both segments for 6 months. For the period ended 31st of March. Actually, that's your financial accounts, not the presentation slides. So if you look at A number 11B, so I was just wondering what is your market share right now, quarter on quarter, or is it? Or if you're not comfortable with the numbers, just wondering, is it just stagnant or increasing or declining?
Look, we've always go back to the AmBank story that we used to talk about. 4 years ago, we used to talk about market share. We no longer do that. We talk about risk-adjusted returns. So the fundamental approach to business has changed over the last few years for us. Okay. What we've always said is, in auto financing, we're quite happy to get the right risk-adjusted returns at the cost of giving up some market share, focusing on the segments that we believe are profitable through a cycle. That's exactly our current focus. We implemented that almost 4 years ago, and we still hold to it. In mortgages, we said we would like to grow our market share. We'd like to grow the portfolio at a faster pace than what we've done historically. But unfortunately, all the pricing dynamics that happened in auto financing 4 years ago shifted to mortgages about 2.5 years ago. And hence, the pricing characteristics of mortgages today is one that's not economic. And hence, while strategic intent is to grow that portfolio, the economics suggest it's not the right time to do so. And hence, we've held off on that portfolio as well. There are some niches which we've gone after in mortgages, by the way. It's not that we've stopped doing business completely. It's just we're doing what we believe is reasonable business, not great business, what we believe is reasonable business to stay in the hunt for a time when the business is probably going to be more economic and more rational. That will happen. It's a matter of time, in my view. but I've been saying that for some time now anyway. So, the short answer is we don't care. Not in those two portfolios. Okay.
Okay, Grace, can we have a next question from the caller, please?
The next question comes from the line of Jinjo Huang of CIMB. Please ask the question.
Hi, and thanks for the call. Just have a simple question. Are you happy with the current growth of the CASA share of deposits? Maybe can you give us an idea on the size of the provisioning going forward? And can I clarify that this has been entirely provided for? Thanks.
Look, I was laughing at the first question. Would you be satisfied with CASA growth? Never. We'd like to do more of that because it's the most profitable business the bank can ever do. So, we'll continue to, it's a key strategic focus area for us across all divisions. We'll continue to focus on it to see what we can do to continue to grow it faster. We have done reasonably well in the last few years through a range of initiatives, and those initiatives will continue. And indeed, we are thinking about new ones that we can potentially concoct to keep that momentum and increase it. Your second question is, are we adequately, what was the question again? Sorry, I missed that one.
You mentioned that you did one last business provisioning due to a restructuring exercise. Can I check with you what was the size of the provision, and also to clarify that going forward, everything is entirely provided for?
Look, it's the same question asked in a slightly different way. The answer is, we will continue to be prudent in our provisioning through different economic cycles. And so at this point in time, as at end of September, are you well provided for? We think we are. But can you guarantee that it's adequate? No one can, because remember, it's the incurred model. So again, we manage it on a portfolio basis where it's appropriate, on a case-by-case basis where it's appropriate through different rigorous judgmental processes. So, and that'll continue. So we're comfortable where we are today, but we'll continue to take a close look at our portfolio to see what's appropriate.
Okay, thanks.
Thanks, sir. Okay, question from the floor. Okay, then we'll take, Grace will take a question from the phone, please.
We have a question from the line of Retake of Manulife. Please ask your question.
Hi, thanks for the call. Just a question on your the increase in your trading and investment income on your non-interest income segment. Could you provide a bit more color on that? What is it relating to? I mean, you mentioned just now a big chunk of it is on lightening of your fixed income portfolio. Are these mainly mark-to-market gains or realized gains or trading income?
Yeah, look, I mean, if you take a look at one of our backup slides on markets activities, slide 36, it kind of gives you a sense on what the markets division has done compared to the same period last year. You can see the markets division has grown its profits by around 50%. Some of that growth has come in from FX and rates, and they are largely what we would call as flow business. So it means as we increasingly do business with our existing customers, with the product suite that's growing, we'll continue to generate better returns from these two portfolios, and that's a portfolio that started only 2 years ago. Within the fixed income portfolio, some of that has come in from some of the underwriting activities that we've done and the sell down process that happens as part of that, and that's contributed to a reasonable extent to markets performance in the first half. The rest of it is simply crystallizing our held for trading and available for sale portfolios that we had in a market where the yields went down quite dramatically and has now since bounced back up a bit. But we do not have much more of that in our portfolio to crystallize in the next period. So now we got our strategy in fixed income has to be one around what can we do in the primary market, and as we do that, what's our strategy in building our portfolio for the potential cycle that might happen in the future. But that's part of what markets business is about. So we'll continue to do what's prudent.
And what would be your normalized sort of profit level for this segment without all these one-off lightening of your fixed income portfolio?
Look, the answer is if I gave you any answer, that's going to be a lie. It's markets. Markets go up and down, and you need to have the right team to trade and use the skill to get the right outcomes from your fixed income portfolio if it's held as part of your traded portfolio. And if you read all the reports that have come out of the Western banks, this quarter has not been a great quarter for most of the Western banks on the fixed income portfolio. For us, it's been decent. But all I'm saying is we're not going to be able to continue to generate those returns in the next 6 months.
Okay. My second question relates to your co-op lending. Can I just confirm that these are based on salary deduction?
Yes, they are.
And are they collateralized?
No, they're not.
They're not. Okay. So basically, these are personal loans then?
These are personal loans to typically civil servants where we get payroll reductions from source. So if you think about what could create issues in that portfolio, it's people losing their jobs or whatever, blah, blah, or not getting getting your operational processes in place. We've strengthened that as we speak. So.
Okay, thank you.
Thank you. Any questions from the floor? Okay, we'll take the next call from the telco, Grace.
There are no further questions at this time. I would now like to hand the conference back to today's presenters. Please continue.
Thanks, Grace. Is there any questions from the floor? Okay, Julian.
Hi, Julian. Just wanted to check, recently the corporate spreads for US dollar lending has widened in the region. Does this have any impact on your group? And also my second question is whether you see any opportunities for domestic corporate spreads to improve.
Well, I think the US dollar assets of Malaysian corporates are actually pretty small, and generally, I think Malaysian corporates do not go into certain type of, even they do lend in dollars, they don't go into certain industries. What we see now pretty obvious is that the exposure in certain sectors like aircraft, ships, which is the strength of some of European banks. Of course, these are all disappearing. And as you know, worldwide, I think currently there's a shortage of dollar, but we are not very heavy on the dollar book, so that won't have an impact on us in that sense. Whether the impact on the margins in the corporate loan market, but the dollar itself, of course, logically should have an impact on the market in terms of funding. But as you know, that the competition in Malaysian market is pretty intense. So the number of new banks have come up, and the focus on lending, particularly more onto the SMEs and the corporate bank is pretty intense. So margins tend to be narrowed. So that's the situation that we are in at the moment.
Okay, is there any other questions on the floor? Can we go to the caller, please? Grace, do you have any questions from the telco?
You have a question from the line of Harsh Modi of JP Morgan. Please ask your question.
Hi, sorry, I had a follow-up couple of questions. One is on international connectivity, there were some initiatives with ANZ. Could you elaborate on that? What exactly were they, and how exactly are we benefiting from those?
Yeah, look, there's a slide on that. It's slide 53 in our pack in the appendix. Harsh, so what are the things that we've done in that space? Look, we've now got a structured process that we put in place with a senior steering committee headed by Mr. Chia at this end and someone senior from the ANZ side. We meet once a quarter. In the recent past, we've launched the AmBank Gets Its Solutions, AmBank ANZ Gets Its Solutions, which is around ensuring that people, the students and others who actually want to go to Australia, for example, have their account set up seamlessly with ANZ servicing it as soon as they land at the other end, and us capturing the parent accounts and ensuring that the transaction happens in a smoother way. We've recently signed Signature Priority Banking Services, which is around ensuring that our affluent segment propositions that we deliver to our customers in Malaysia are ones that we leverage off ANZ region and get both the IP behind it as well as access to the premier lounges that they've got, and we've got in a more integrated way. Currently, we don't have any of those arrangements in place. We've also done other things outside, like we've launched some foreign currency capabilities in some of our branches. We partnered with Western Union on some money transfer services. We've got a two-way customer referral program that seems to be increasing in strength by the day, which helps us do business with companies that might have a regional presence or in Australia or New Zealand presence, like with business and with the business growth expectations in Malaysia. And they've also, joined us in helping us raise some funding recently in the US dollar market at levels that we wouldn't have been able to do on our own. So, that international connectivity from ANZ continues to strengthen. Now, you've also got, good value. If I think about IAG, the CEO for AmG is from IAG today, and he's got a few people from IAG working, with him very closely on building out the general insurance business. Again, on the life insurance side, we got people from Friends Life working with us to try and build that business out. So, generally speaking, that the collaboration initiatives, leveraging our international partnerships, are getting stronger and stronger.